Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is August 25 and this is a weekly markets update. Let's have a look at the news of week 34 and see what are the next trends. The dominating theme of nitrogen market last week was the Indian tender and participation of Chinese tons there. It is still unconfirmed, but most likely China will let its exporters to supply directly to India, and most of the additional export quota of 700,000 tons will be shipped to the tender. This news acted as a cold shower for the international market that started to warm up in front of the tender closure. China exported almost 650,000 tons of urea during 7 months of 2025, and over 500,000 of these tons were exported in July only. Clearly, the whole export quota announced for 2 million tons will not be utilized because it included both prilled and granular product. Well, prilled was not popular without shipments to India. However, now, if Chinese tons can go to India, prilled quota might be utilized. Apart from these discussions, there was not much actual business happening last week. Producers across the globe tried to support offer level, but sparse bids were much lower those levels, and in general, notional prices slipped. European demand was absent, and no fresh sales were registered either from Egypt or Algeria. Turkish buyers also stayed on the sidelines. Iranian producers scrapped several tenders in the absence of the bids. Target price level was corrected downwards to $435, but definitely in the bearish market, this level is unachievable. Middle East producers haven't sold any fresh tons last week, trying to maintain offers at around $500 FOB level in front of the Indian tender closure. However, bids are much lower, about $30 lower than that, so we will see correction for sure. Indonesian Kaltim also scrapped its last week tender due to much lower bids around $470 FOB level versus producers' expectation. Demand in Southeast Asia is very slow. Brazilian demand continued to be skewed towards sulfate, and bids for urea were at the same level, around $475 CFR, which was about $20 away from the offers. This level is valid for non-Chinese product, while Chinese is proposed at lower level, however with little interest from the buyers. Paper values were all in red last week, as news about Chinese export quotas and shipment to India negatively affected market sentiment. Egypt FOB dropped by $15 for September and remained at the average of $475 for October. Arab Gulf FOB values corrected downwards for both September and October by $12 and $5 respectively. Brazil CFR hovered on the levels similar to last week with some fluctuations. NOLA FOB softened significantly for both months ahead. Ammonium sulfate market remained very slow last week. Chinese FOB copper price slipped more, and it is already 2 months of consequent downward price correction. SCC closed the tender at $155 to $60 FOB for almost 35,000 tons to be shipped in September. Brazilian sluggish demand is the key factor of such dynamics, of course. Last week, a lot of about 10,000 tons was sold at low $190s CFR, and another smaller cargo sold at high $180s CFR, but that was it. Elsewhere, the demand was almost non-existing. In the nitrate segment, not much is happening. Most of Europe remains out of the season, and there is little demand. In the UK, it is estimated that patchy rains and the warmest and driest summer in 50 years has impacted farm yields. Consequently, nitrates buying for 2026 is being deferred, and it is estimated that overall nitrogen demand for spring 26 will be down by 20%. In Germany, distributors reported they did not receive a single inquiry for now. Farmers have completed harvest and are taking a small break. CIN is still priced at 320 euros CPT, but there is no buying activity. In Poland and the Baltic states, the ammonium nitrate market is flat. Producers are holding on to prices for the time being. As urea is not competitive, they are good for now. Still, the overall market mood is that there should be some correction in September. The market expects Yara to announce new post-harvest prices in late August or in the first week of September. Russian Eurochem plant in Vinomysk has resumed production 3 weeks after it was damaged in drone attack. Offers from Baltics to Brazil drifted lower as Brazilian demand is largely subdued. As per information from the market, demand for sugarcane is covered only by 70%, but there is no place in port warehouses, so imports stalled. In the ammonia market, prices remained unchanged last week, and all eyes are now at September Tampa contract price settlement. It is expected to increase moderately due to very healthy import lineup. Exports from the US also remain robust, with prices around $420 to $40 FOB. In the Trinidad, producers expect clarifications from the National Gas Supply Company regarding gas curtailments that were expected for some time. If confirmed, supply west from Suez will diminish in September and prices will correct upwards. In Algeria, no fresh sales emerged, and in general, clarity is lacking in terms of supply from there. If supply was fully restored after outages in August, still unclear, as there were no shipments from AOA since July. In Turkey, Gemlik sold a cargo of 15,000 tons, but the price was not disclosed. East of Suez, the market was quiet, with production being stable and demand mostly subdued, both from fertilizers and industrial segment. In phosphates market, the main development is related again to Chinese exports. China is about to issue new export quotas, which are expected to be between 700,000 and 1 million tons. Likely DEP will make about 70% of the quotas, the rest will be MAP. This is still unconfirmed, but the sentiment in the market becomes more relaxed, because scarcity of Chinese exports was the key reason for phosphates prices surge this year. Another big news, same as the nitrogen segment, is resuming of Chinese exports to India. Again, if confirmed, the problem with the lack of phosphates might be solved. There were no fresh sales to India last week. Hurl has received only 2 offers in its tender for 50,000 tons of DEP to the West Coast and issued a counter-offer at $805 CFR, which is lower versus the offers. The tender for the same amount to the East Coast was prolonged to August 26th due to lack of offers. Suppliers resist lowering the price level. However, it is inevitable as soon as Chinese tons appear in the market. Bangladesh is the main direction for non-Chinese tons now, and ABC has awarded around 255,000 tons of DAP last week. Chinese suppliers might also commit for about 200,000 tons, but price level was not attractive enough for them, so they haven't decided if they participate or not. Ma'aden sales to Pakistan last week supported elevated DAP price level because 60,000 tons were sold at $820 FOB for September loading. Pakistan was also struggling to import the amount needed, and its imports lag behind figures of previous years. Brazil is facing clear demand destruction due to unwillingness of international sellers to drop prices further from current level, assessed at $750 CFR for MAP. But demand hits the wall of farmers' credit issues and extremely low affordability. Buyers are constantly trying to find cheaper alternatives like TSP, SSP, and low-content NPs. In the US, market activities was subdued and there were no fresh sales registered last week. In general, price sentiment is bearish, mainly due to softness in corn market. Moving to the fundamentals. European natural gas futures climbed back above 33 euros per megawatt hour as optimism over a quick peace deal in Ukraine faded. Traders now expect Europe will continue facing tight supplies, with no sign of Russian flows returning. The market is also bracing for Norwegian maintenance work that will temporarily cut output, adding to supply risks. To secure liquefied natural gas cargoes against Asian competition, Europe may need higher prices, especially with storage levels lagging last year's. EU reserves are just under 75% full, compared with more than 90% a year ago, leaving EU more exposed heading into the winter heating season. US natural gas futures fell toward $2.7 per MMBtu on Friday, their lowest since November, as supply remained abundant. Production averaged a record 108 billion cubic feet per day so far in August, slightly above July. Despite hotter than usual summer temperatures, strong supply has allowed storage levels to remain well above average, about 6% higher than typical for this time of year. LNG export flows have risen modestly, averaging almost 16 billion cubic feet per day in August. With weather expected near seasonal norms through early September, demand is unlikely to spike, keeping prices under pressure despite occasional short-term gains. Agricultural commodities future prices were again in the red zone last week. Wheat futures rebounded to $5.05 per bushel after price touched the bottom on Tuesday, driven by short covering and a bounce of technical resistance levels. Prices remain near a 5-year low, pressured by ample global supply and rising forecasts for Russian 25 wheat crop. In the US, latest USDA estimates showing the winter wheat harvest progress is nearly complete, with 94% harvested. Good weather windows have helped accelerate the spring wheat harvest progress and helped it catch up to the long-term average. Overall, wheat futures showed modest recovery amid a mix of technical support and global supply expectations. Corn futures rose above $3.8 per bushel, supported mainly by strong export sales of 25-26-year crop in the US. New crop bookings were confirmed at the level of 2.86 million tons, nearly 40% higher than the previous week, and the second largest for the marketing year. Mexico and other unspecified destinations were the top buyers. Despite strong supply prospects, concerns remain over southern rust and disease pressure in Iowa and Minnesota fields, which could limit final yields. At the same time, scorching temperatures are hurting the European corn crop, putting the region on track for its biggest import of the grain in 3 seasons. The heat has significantly dampened the outlook for corn quality and yields, especially in key producing countries. Soybean futures continue significant fluctuations, rising due to strong weekly exports, hopes that China may resume buying US crops, and a rally in soy oil that offsets supply pressure from favorable US field conditions. Prices had surged nearly 5% on Thursday, following reports that the US administration might issue a ruling on biofuel exemptions for small oil refineries, which could sustain demand for feedstocks including soy oil. Traders also speculated that China's inquiries about US soybeans could support demand, although no purchases had been confirmed. Moving to the shipping industry. Containerized freight index continued its steady decrease by another 45 points last week. Trans-Pacific spot rates declined by 3 to 5% last week, depending on the route. The phase of accelerated purchasing by US retailers, which induced an early peak season, has ended. In response to a decelerating US economy and increased tariff costs, they are now scaling back on procurement. China to Europe rates also dropped by 3 to 6%. General expectation in the market is unchanged. Spot rates will continue declining further during this year. The Baltic Exchange Rate Index dropped by 100 points during past week. The Capesize market endured a notably weaker week, mainly due to lack of consistent minor presence in the Pacific, weighing on sentiment. The Panamax market was moving differently in Atlantic and Pacific again. While in the Atlantic, the continued lack of early tonnage had a profound effect on rates, in the Pacific, rates were sliding day by day as tonnage count began to outweigh any demand. For Ultra Supermax, it was a solid week across regions, with demand staying robust. Same it was in the Handysize segment, where Atlantic showed very healthy results, while Asian arena remained rather balanced. To sum up, Urea market was focusing on the outcome of India-China discussions, if Chinese urea is going to head to the next Indian tender. Anticipation of this strategic move weighed on market sentiment, and prices slipped across the globe, also amid sluggish demand elsewhere besides India. Issues in Brazil related to ports overstock and farmers' access to credit limited demand for both urea and even sulfate, which is much better priced in terms of cost per nitrogen content. Due to that, sulfate price in China dropped more and will not come back on stable track until Brazil buying resumes again. Ammonia price was stable both west and east of Suez, but anticipated gas curtailments in Trinidad and healthy exports from the US will influence global balance and most likely push up September Kappa contract price respectively. China was the newsmaker in the phosphate segment as well, with additional export quota of as much as 1 million tons likely available for shipment also to India. Same as in nitrogen segment, this news cooled down the market and prices cemented on the previous level. Natural gas price in Europe increased as peace discussions between Ukraine and Russia seemed to stall. Price in the US dropped a bit more due to healthy supply. Agricultural commodities future prices rebounded but very slightly last week. The situation is very stable and prices are moving as on the roller coaster. Ample supply in general weighs on prices, while growing conditions might bring some surprises later in the season, especially outside of the US. Container shipping rates continued steady downward correction, and bulk shipping activity was rather slow, mainly due to sluggish demand in Capesize segment. So, let's see what is next around the corner, but it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.